If you form an LLC the wrong way in 2026, it will cost you $40,000 over the next 5 years. I've seen it happen 200 plus times. And the worst part, most CPAs are setting their clients up exactly this way. So today, I'll show you the 5 mistakes and how to fix them before December 31st. I'm Henok Kebede. I'm a licensed certified public accountant and founder of HK Financial Advisory. For nearly 15 years, I've helped business owners save 5 to 6 figures in taxes legally using strategies most accountants never bring up. See, forming an LLC is not just a legal task, it's a tax strategy decision. And almost nobody treats it that way. So in the next 10 minutes, I'll walk you through the 5 LLC setup mistakes quietly draining $40,000 from business owners, what the IRS code actually allows you to do instead, and the exact order I'll set up an LLC if I were starting over in 2026. If you make over $80,000 in your business, stay until the end. Mistake number 5 is the biggest one. So let's get into it. The first and most expensive mistake is forming an LLC and stopping there. See, by default, a single member LLC is taxed as a sole proprietorship. So that means every dollar of profit gets hit with self-employment tax of 15.3% on top of your income tax. So here's where it hurts. A client of mine, let's call him David, was making $150,000 a year as a consultant under his LLC. He came to me paying $22,000 a year in self-employment tax alone. We filed Form 2553 and elected S-Corp status. We set a reasonable salary of $70,000, took the remaining $80,000 as distribution. That single move saved him $14,000 a year in payroll taxes. Every year, forever. So who qualifies? If your business profits $50,000 or more, the S-Corp election is usually a no-brainer. But below that, it may not make sense yet because of payroll cost. So here's where people mess this up. They wait until April to think about it. The S-Corp election must be filed within 75 days of forming your LLC, or by March 15 to apply for the current year. If you miss that window, you're paying full self-employment tax for the entire year. Mistake number 2 is forming an LLC in Delaware, Wyoming, or Nevada when you actually don't operate there. You've seen the YouTube ads, form in Wyoming, no state income tax, anonymous. And see, for 99% of small business owners, this is a trap. And here's why. If your LLC is registered in Wyoming, but you live and operate in Virginia, you have to register that Wyoming LLC as a foreign LLC in Virginia anyway. Now you're paying 2 state filing fees, 2 registered agents, 2 annual reports, and you still owe state income tax wherever you actually do the work, because state tax follows where you earn it, not where the paper LLC sits. So here's an example. One of my clients formed in Wyoming because TikTok told him to. He still lives in Maryland. Cost him $1,500 a year in duplicate fees for 5 years before he came to me. That's $7,500 gone for nothing. So who actually qualifies for out-of-state LLC? Real estate investors holding property in that state. E-commerce sellers with no physical nexus. And very special legal setups. So what's the fix? Form where you live unless you have real business reason not to. Mistake number 3 is treating the operating agreement as optional because your state does not require it. See, most states do not require it. Most courts do when they decide whether to pierce your LLC's liability protection. Here's how it goes wrong. You get sued. The opposing attorney digs into your LLC. No operating agreement, no board minutes, no clear separation between you and the business. The judge rules your LLC was an alter ego of yourself. Your personal assets are now on the table. Your house, your savings, your retirement. That's called piercing the corporate veil. And it happens. I've watched it happen. A proper operating agreement spells out ownership, voting rights, profit distributions, dissolution rules, and member responsibilities. It's not paperwork, it's an armor. So who needs it? Every single LLC member, multi-member, it doesn't matter. The mistakes to avoid are downloading a free template from Google and never customizing it. Generic templates skip the clause courts actually look for. Get one drafted properly once and you're protected for life. Mistake number 4 is using your business account like a personal checking account. I see this every tax season. Business owners running personal Amazon orders, dinner dates, vacations, all through the business debit cards. Two things happen. First, the IRS disallows your deduction in an audit because you cannot prove what's business. Second, and worse, co-mingling is the number one way courts pierce LLC liability protection. You lose the very thing you formed the LLC to get. Here's the fix. One business bank account, one business credit card. Every transaction runs through it. Personal expenses come out as owner's draw or salary, recorded properly in your ledger. This is something we set up for every new client during onboarding. It takes 1 hour, saves you 10 years of headaches. And the mistakes to avoid is telling yourself, I'll clean it up at tax time. Because from my experience, you won't. Set the system up from day one. This is the one that hurts the most. Mistake number 5, forming your LLC, getting profitable, and never setting up a solo 401k. See, in 2026, the solo 401k contribution limit is $72,000, $80,000 if you're 50 or older. Every dollar you contribute is a tax deduction. And if you're in the 32% bracket, that's up to $23,000 a year in tax savings alone. And you still keep the money. It just sits in your retirement account growing. So here's an example. A client is doing $250,000 a year in revenue through her S-Corp LLC. We set up a solo 401k before December 31st. Maxed out $72,000. Her tax bill in April dropped by nearly $23,000. Same income, same business, one additional account. So who qualifies? Any LLC owner with self-employment income and no W-2 employees besides yourself and your spouse. The mistake to avoid here is waiting until tax time. The solo 401k must be established by December 31st of the tax year you want to deduct. April is too late. And here's the one most CPAs never mention. Once your LLC is an S-Corp and you maxed out your solo 401k, set up an accountable plan. Unless your S-Corp legally reimburse you for home office, mileage, cell phone, and internet, tax-free to you, deductible to the business. Most of my clients add another $8,000 to $12,000 in deductions from this one move alone. So, forming the LLC is the easy part. Forming it correctly, the S-Corp election, the right state, the operating agreement, clean books, and a solo 401k on top, that's what separates the business owner who keep their money from the ones who hand it to the IRS. Here's the timing rule that matters more than anything I just said. Tax planning happens before December 31st, not in April. April is when you find out what you owe. December is when you control it. If you're a business owner making $80,000 a year or more, and you want me and my team at HK Financial Advisory to look at your setup, find the $14,000, the $23,000, all of it, book a free strategy call with us. The link is in the description. We only take 5 new clients a month, and Q1 is when most of them come in. If this video helped, drop a comment with the mistake that hit closest to home. I read them all. And subscribe so I can keep showing you the strategies the IRS doesn't advertise. See you on the next video.